Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the Wall Street jungle. And today we're diving into Iron Horse Acquisition 2 Corp's annual report, which is basically a status update for folks who invest in these shell companies looking for a bigger fish to merge with. Hope you are ready for some SPAC. Tacular Insights Wink. Before we jump into the nitty-gritty, if you love getting these easy to understand breakdowns of complex financial documents, do us a huge favor and hit that subscribe button. And hey, we have a fantastic community over on Discord, so join us there for even more insights. The link is in the description below. So, Iron Horse Acquisition 2 Corp is a special kind of company. It is called a SPAC, or a Special Purpose Acquisition Company. Think of it like a company with a big pile of cash that hasn't bought anything yet. Its whole job is to go out, find a real business to buy or merge with, and then, boom, that business suddenly becomes a public company. This report is all about what they've been up to in their fiscal year ending the 30th of November 2025. And let me tell you, it is a story of preparation and a whole lot of waiting. First off, let's peek at the financial table. As of the 30th of November 2025, Iron Horse Acquisition 2 Corp had total assets of about $364,000. Now, that might sound like a lot, but remember, most of the money they raised in their big public offering, which was $230 million. Is sitting safely tucked away in a trust account. That is by design because they haven't found their target business yet. They are not an operating company, so they don't have factories or products. Their assets are mostly cash and some prepaid expenses. On the liability side, they had about $538,000 as of the 30th of November 2025. This includes things like accrued expenses, which are basically bills they owe, and a promissory note to a related party, which is a loan they took out. Remember, these numbers are before their big IPO on the 18th of December 2025. That IPO brought in a massive amount of cash, which significantly changed their financial picture right after this report's period. Now, for the shareholders' deficit, which was a negative $173,000. This basically means that at that moment, the company owed more than it owned in terms of actual equity. This is pretty typical for SPACs before they find their target, as they have operational costs but no revenue generating business yet. Looking at their results of operations for the year ending the 30th of November 2025, they had a net loss of about $204,000. And for the very short period they existed in 2024, it was just over $1,000. This loss is pretty standard for a company that is just getting started and incurring expenses for things like legal and accounting fees as they prepare for their big business combination. They are not generating revenue because they are not an operating business yet. In their cash flow from operating activities, we see a negative number, around $142,000 used in operations for 2025. This is also expected as their main goal is to find a business, not to generate profits from operations at this stage. Their financing activities show a bit more cash coming in, including about $285,000 from a promissory note, which is a loan. And some repayments. It is important to note that on the 18th of December 2025, which is a subsequent event to this financial statement date, they closed their initial public offering, bringing in $230 million. This is the big catalyst for their business, and it means they now have significantly more resources to hunt for that target business. They also raised another $5.7 million from a private placement. Now, an interesting detail here is the going concern consideration. The auditors pointed out that based on their situation before the IPO, there were doubts about whether the company could continue operating. This is super common for SPACs before they successfully complete their IPO and secure their funding. But with the IPO now complete and that trust account loaded, they have a much clearer path forward. The report explicitly states management plans to address this uncertainty with the business combination. And with the funds raised, this is no longer a significant immediate concern for the going concern matter. Let's talk risks because for a SPAC, this is where the real story lies. One of the biggest risks is that they only have a limited time, typically 24 months from their IPO to find and complete a business combination. If they don't, they have to dissolve and give the money back to the shareholders. This time crunch can put pressure on them to make a deal, even if it is not the perfect one. Another point is that shareholders might not always get a vote on the actual business combination. The company can sometimes choose to do a tender offer instead, meaning shareholders can choose to sell their shares back if they don't like the deal, but it bypasses a formal vote. This can feel a bit like a take it or leave it situation for some investors. And then there's the risk of third-party claims. While they try to get everyone involved to agree not to touch the money in the trust account, there is no absolute guarantee. If creditors come knocking, that $10 purse hair investors expect back might shrink. The sponsor has agreed to cover shortfalls. But there is always a question of whether they have the deep pockets to actually do so if things go really wrong. Which, by the way, the report mentions they do not believe they have significant liquid assets, which is a bit of a red flag. Now about the leadership. Our officers and directors are not obligated to devote their full time to this SPAC. Several of them are involved in other ventures, which creates a potential conflict of interest. They might have to split their time, and their loyalty could be divided when deciding which business to pursue for a merger. This isn't uncommon, but it is something investors need to be aware of. Looking at who owns the company, we see Iro SPAC sponsor LLC holds a significant chunk, with Jose Bengochea and William Caragol being key figures associated with it. They have a large stake, and because they bought their shares at a very nominal price, they have a huge incentive to get a deal done. Potentially even if it is not the absolute best for all shareholders. This is a classic SPAC dynamic the founders get in cheap and cash out big if a deal happens. The auditors, Malone Bailey LLP, have given their stamp of approval, stating the financial statements present fairly. However, they also flagged that going concern uncertainty, as we discussed. It's important to remember their job is to report on the numbers and the accounting, not to guarantee the success of the company's business strategy. So what is the big picture here for Iron Horse Acquisition 2 Corp? They're a SPAC, and their primary goal right now is to find that business to merge with. They've successfully completed their IPO, which is a major milestone, and that means they have access to substantial funds. The risks are typical for SPACs: the ticking clock to find a deal, potential conflicts of interest with management, and the inherent uncertainty of merging with an unknown business. The financial statements, as expected for a pre-business combination SPAC, show operating losses and a shareholder deficit. But those numbers are completely overshadowed by the capital they raised in the IPO. The real test will be how effectively their management team can identify and execute a business combination that creates value for shareholders, especially given their limited time and the potential for conflicts. Alright, that is our breakdown of Iron Horse Acquisition 2 Corp. Its latest report. What is your take on these SPAC dynamics and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.